Welcome to the AJ Brown Show, where we talk about all things investing, options trading, and the like. Now, here's your host, AJ, whose primary mission in life is to help you become a better investor.
All right, ladies and gentlemen, welcome to another episode of the AJ Brown Show, special edition, broadcasting
We
from
are live.
sunny Los Angeles.
Look at
AJ
how sunny it is.
Right, AJ is on his vacation trip, right? And
Yeah.
he decided he wanted to stop by the sunny California.
Yeah.
And here we are, a special edition of the AJ Brown Show. Good morning, AJ.
Good morning, Sip. We're in person. I'm like looking at the camera. Good morning, Sip, but you're right here. That's awesome.
Yeah. The one thing I was thinking about this morning is we have this summer doldrum going on. People are on vacation, but the market never stops. One of the notes that I saw this morning was that today's a big option expiration day.
Right.
And I think it's moving things.
Yeah.
What are your thoughts on that?
So we're always going to see increased volume on expiration day. And for folks that use volume as a validator, you have to be careful on options expiration day. Think about what an option is. An option is an agreement to exercise or to do a transaction on a future date, the expiration date of the option. And so what happens is on that expiration date, all these transactions that get lined up happen, and people are trying to close positions ahead of that happening. So it creates a huge spike in volume. And so for the people who don't know about option expiration date, they might think that that's a confirming signal for a price action, but it's not. And at the same time, right, people ahead of options expiration are going to do a whole bunch of transactions to adjust. And so that can create kind of the movement that we're seeing here across the market. But I think, Sip, we're seeing a lot of extra movement that doesn't have to do with options expiration. I think we've actually found ourselves at top.
Yes, let's pull up the chart. Here we go. We've been rallying the last maybe 2 weeks or so.
Yeah, maybe too long, because if you have a rally that goes too long, what that winds up doing is it winds up making it run out of gas and then peter out quite aggressively. But you can see right here, the indicator, I just use a simple 3 and 5 day exponential moving average crossing, which is, I hacked into the MACD definition of this indicator. And so instead of being a MACD, it's actually showing us when the 3 and 5 day EMA cross. So whenever the 3 and 5 day EMA cross, they cross over this zero line. So you see, we're about to get a zero line crossing here, telling us that the top from about 3-4 days ago was our top. So I'm going to just really quickly zoom in on that. And so if this was the top, and I zoom in on the whole move, if I draw say this is, for instance, this is 100% of the move, we're actually going to expect a little bit of a drop to about 50% of that move. So somewhere between about 4,000 and 4,100 is where I would expect us over the last weeks of August to pull back, to give us enough kind of reset in order to go higher in September. So for the next couple of weeks, Sip, I'm actually believing, especially if we get this crossing and it stays crossed, right? It goes down like this and it continues to go down. I'm expecting us to actually pull back, and people who are short-term traders, you may want to bank on the fact that we pull back to about the 4,000 mark, maybe as much as 3,900 all the way up to 4,100 before we start heading up again.
So the fact that we know that now, and because it's options expiration, is there a specific type of mentality to take going into this second half of the year?
Well, maybe not for the second half of the year, but for the next 2 weeks is an amazing time to sell call premium. because for the next 2 weeks, we can actually profit on this kind of pullback, this contraction, if you will, by selling premium. No other person, stock traders, index traders, ETF traders, they can't profit this way. But because we have the options to do it, we can totally profit by this little pullback.
Yeah. There we go. Wonderful. So with that, we've got a couple names that
You got a wireless mic? That's awesome. Oh, you're using your headset. That's cool. I'm like, oh man, he looks so much like Streamlined, and I got these big old cans on.
Yeah, but you know that's old school. You've been doing this for a while.
That's right.
All right, so we got a couple names. Do we want to run through that? Maybe we're looking at, you're looking at, or the team, the members at Trading Trainer, because I know every week you're getting together with the crew. You're identifying signals. I feel like this week, today is a great name or a great time to go over.
Yeah, especially with this top forming. I mean, anybody who is long some symbols or long some call options, this is an opportunity probably in the next day or two to sell some premium. And I got to say, yesterday my team and I met. And what I do, just to let you guys know out there in internet world, what I do is I let my team, I give them instruction on how to find good candidates to sell premium on. And then every Thursday, my team comes and we're talking about as 50 people and as much as like 200, 250 people come. They come with picks that they think would be good to sell premium on, and they throw it at me and one of my coaches, and we look at these candidates for the first like 10 minutes of the workshop, and we pick one that is the lowest hanging fruit. Like what is sure to be the one that's going to make us profit with the least amount of our effort and investment and anxiety. Because a lot of people who actively invest, anxiety is like the worst thing that can happen. And so they came yesterday with all sorts of tickers that just blew my mind. I mean, we couldn't decide on what was the easiest one. And then once we picked one, and I actually let them vote. I said, these 3 out of these 10 that you brought us could equally be the best of the best. And so I had them vote. And so there's just so many candidates you can be profiting on right now. But yeah, some of the candidates that we didn't go over, one of the ones I wanted to bring to people's attention was ticker Zim Integrated Shipping Services. So this is a company that does like they manage the containers, that all the stuff that got kind of backlogged last fall. It's a year later, and they're not as backlogged as they were. So they seem to be moving sideways. And I wanted to feature this one because this is like the candidate that would be fantastic for owning in your portfolio for the long term. And so instead of just buying it outright, so for those folks, if you've got a candidate that you want to have in your portfolio for the long term, meaning for the next 6 months or more, something that would consider long-term capital gains, instead of buying it outright at whatever price it's going for, if you've got some patience, can get it at a discount. And the way you can do that is by selling puts. So say, for instance, Zim right now is trading at about $49. That's what we see right here. And say we would love to add this to our portfolio, but not at the $49 price, at the $45 price. So what we could do, first of all, we'd make sure that we have $45 per share, however many shares we want to buy. And we would do this in lots of 100 because that's how options work. So you come over here to the option chain. And so we'll talk about the September 16th option. But if you were doing weeklies, we could totally look at weekly options as well. You could do this every week. So now that I've pulled this screen up, you could do it for August 26th, again on September 2nd. Every Friday, there are options expiring. So let's look at the August 26th, the ones that not expire today, but expire next Friday. I could say, sell this $45 put and I'm going to make $1.60 per share. So because options are sold in lots of 100, I'll make $16 immediately by selling this put. And what's going to happen is if the price of ZIM drops to $45 before next Friday, well, then I'll buy the stock at $45. That's what that put contract gets me. It gets me the stock for $45. If ZIM doesn't drop to $45, I'm going to keep the $1.60 no matter what. So I get to kind of win. And if I don't need to have ZIM right away, but I want to have ZIM over the next years, I can be strategic on my purchasing. And if I don't get it every Friday, I can just keep doing it. And every Friday, I'm going to make some sort of small premium, like $16 a contract. And I'll just keep making $16, $16, $16 per contract until I finally buy ZIM at the price that I set. So all to say, Sip, when you do with options, what's really cool is that people say options create risk. What it creates is certainty, right? Options, I can be certain that when I buy ZIM, it's going to be at $45. I'm not going to be having to pay whatever the market decides. I get to choose, now that I'm using options, exactly what price I buy this stock at. And if I don't get my price, well, then they give me a premium instead.
And if you don't get filled at the price, you got a lot of options to work with, not options as the contracts, but because there's so many opportunities, so many different types of markets, you got individual names, you got ETFs. And I think later on, we'll touch on one of the things that I always bring up is the price of the stock, right? It really does affect the type of options that you can get in and things like that. It
does. The price of the stock is critical. So we should talk about that. Yeah.
Because what you were looking at here with the ZIM is a $45 stock, which means that you would need $450.
Well, it depends on the price of the option. So for instance, when I look at the price of the option, you'll see these two columns. So on this side of the option chain are our puts. And on this side of the option chain is our calls. And so what, there's the bid and the ask price. That kind of is, the bid price is the price at what people are trying to sell things for, and the ask price is what they're trying to sell them as. So if I'm bidding, I'll bid, $1 to buy your option, and you're asking $1.50. And once we come to an agreement, that's the trade price. So if I'm saying $1, you say $1.50. If we never agree, the transaction will never happen. But if you come to $1.25 and I come to $1.25, the transaction happens. So they calculate this thing called the mark price. And the mark price is halfway in between the bid and the ask. So when I'm quoting prices, I'm usually looking at the mark, assuming that any transaction that's going to happen is halfway between bid and ask. So if the mark price for a particular option is $4, like we see here for the 48.50 put, well, then $4 times 100, $400.
Right. And so the lower the stock price, the least expensive the option contracts are.
Right.
And does that plays a little bit in your strategy, but at the end of the day, it's a smaller portion of all the other components you need to fit in place.
It's a smaller portion, like mathematically, but when you think about a successful investor, has to, there's three really important things that a successful investor has to be able to do. They have to be able to manage risk. And I would say that's about 50% of the puzzle. It's not hard, and it doesn't take a lot of math or a lot of even thought process, but it's 50% of the puzzle. And then I would say 40% of it is controlling your emotions, not doing stupid stuff because you get excited. And then 10% is the strategy. So it's interesting because when you go to like a trade show for trading, like one of the traders expos or something, and they have the whole conference room with all the different booths, all the booths and all the software that the people are hawking, all are for that 10% trading strategy piece. And like anybody who's talking about emotions or trade management, which is 90% of being successful, is usually put in a booth behind the snack bar because it's so freaking boring, but it's so important. So when it comes to why, for instance, on the premium selling, we like the lower price stocks the most, it has to do not with the price of the option as much as the price of the risk associated with that option. So, for instance, somebody yesterday at our workshop was asking about Apple. So if I come over here to the price of Apple, I'll bring up the chart because it's a little bit more showy. AAPL. Apple is trading at $172 per share of the stock. And when you think about the share price of the stock, the option is going to be kind of commensurate in price. What a lot of people say, like for instance, we were thinking about buying like a November, we'll go to at the money, a November 175 call. That's going for $9.15 an option share, so $915 per contract. People will like look at their portfolio and they say, well, I've got a $5,000 portfolio. I can buy 5 of these contracts. But that's not the thought process you want to have. What you want to do is, can you afford the risk associated with those contracts? So what you really have to do is you have to say, my portfolio is $5,000, and on any one investment, on any one trade, how much of that portfolio am I willing to lose? So say, for instance, $5,000, I like to tell my folks to not lose any more than 4% of their portfolio if everything goes freaking wrong. So a $5,000 portfolio, that's like $200. 4% of $5,000 is $200. So what you need to do is you need to be able to evaluate your trade and evaluate if every freaking thing goes wrong in your trade, how much will you lose? So in the case of this Apple trade, you may lose up to something like 20% if everything goes wrong. So you don't want to use your whole portfolio, because if your portfolio is capped at a 4% loss, you don't want to lose 20% on your whole trade, because that would be more. In other words, you have to use about a fifth of your portfolio, because if a fifth of your portfolio suffers a 20% loss, it results in only a 4% loss in your portfolio. Now, a lot of that is throwing some numbers, and not everybody can see the numbers in the air like I can and do the math in their head. So that's why you can use spreadsheets in our program SIP. We give everybody a worksheet that does all this math for them. But the point is you don't want to just say that I can afford the option. What you want, the better question to ask is, can I afford the risk? Because in that case, if I'm only using 20% or 1/5 of my $5,000 portfolio, it's not that I can buy 5 contracts. I would only be able to buy 1 contract of this Apple stock in order to keep that risk in check. You don't want to risk any more than 4% of your portfolio. You want to be able to, if everything goes wrong, SIP, you don't want to lose your whole portfolio. If you risk only 4% of your portfolio, you would have to do 25 really horrible trades in a row, like lose everything. Like they'd have to be the worst case trades for you to wipe yourself out. And at least if you guys are following my methodology, if you have 3 of those in the row where everything goes wrong, you need to stop what you're doing and go back to paper trading, because it's not the market throwing you a curveball. It's you messing up. There's something in your process that you're doing wrong. And so you need to go back and examine what you're doing. I call it the hat trick. If you get the hat trick, you do 3 trades in a row that go to the worst case scenario and you lose 4% up to 12% of your portfolio. Stop. Because worst thing, I used to do a lot of live trainings, and always at the break, when people are hanging around the water coolers or the coffee pot, somebody would come up to me and they'd be like, man, I was doing some option trading strategy And I was doing well for like the first, second, third, all the way up to the 10-month. I was earning double-digit gains. And then on the 11th month, I lost everything I earned on the first 10 months, plus half my portfolio and my wife and divorce. And I'm like, if you follow this methodology, there's no way that can happen. You can't lose all your gain, so the reason why we're always looking at symbols under $30, $40 is because we're pricing in the risk of doing the trade. And that's where most of our portfolios, if your portfolio's anywhere from say a couple thousand up to say 50,000, that's your sweet spot. Now, when you start to have 6-digit, 7-digit, and 8-digit portfolios, fine, you can do some of this trading, but most of us are dealing with, a couple thousand, maybe a retirement account up to 100,000. You're going to want to focus your option trading on underlying symbols that are maybe $30 and less.
Yeah, and you bring up the 4% rule, right? But on the reverse of that is some of your strategies, at least from a lot of the examples that we've gone over in the show, have 15, 20% returns. And so when you're on the right side, using the risk parameters,
that's right,
you are rewarded, which is the whole reason that we're involved in this in the first
place. That's absolutely right. So you get the rewards. And I'm telling you, when we estimate what the worst case scenario should be, that means that like the planets have aligned, that every single thing has gone wrong. And so by adjusting the risk model for that, we prepare so much for the worst that your expectations, I always have happy traders, because your expectations are set so low that when even one or two things go right, you do better than you expected. So that's what I recommend. That, in fact, if you look at successful traders, that's exactly what they do. They always manage their risk. They prepare for the worst, and they're always pleasantly surprised when even one or two things, let alone when all things go right. Then they're like, oh my God, I was ready for a big loss, and that just didn't happen.
All right, cool. So with that, we're going to go ahead and run through some more names. But before we do that, we're going to go ahead and give you guys an opportunity to jump into AJ's workshop here. And then if you have any questions on any of the names, or if you have a name or something that you want to call out, feel free to drop it in the chat, and we'll be right back.
I get it. You're afraid of trading in the markets. Guess what? I've got your answer. I've got 4 strategies I'm going to give you, along with the tools to make it super easy. I'm going right home, giving you the webinar. I need you to sign up below and meet me in a few minutes.
All right, guys. Sorry for any of the echo that you might be getting. This is new for us, right?
Yeah. Very rarely are we on the same coast. I kind of like the best coast, by the way. And well, look, I don't know if you guys can see this, but that's Columbia Pictures right there. We're near Sony Studios. My gosh, I'm right in the middle of like history in as far as like movie making goes. It's so cool being here.
Definitely. Well, this is my home territory, and as AJ said, we had a nice little team outing yesterday, and it is summertime, so spend some time with the family, take a little vacation, but the markets are not going to sleep. Things are moving, unlike we've seen in past years, and we've got some inflation data that's going to be coming out. We've got some Fed data that's going to be coming out.
Should we look at the economic calendar?
Let's go ahead and pull up the economic calendar and just get a quick run.
There wasn't much happening this week. I gotta say, when I pull up the calendar, we had industrial production numbers. So I always like to give people a prime on what they should be paying attention to. This is super zoomed in. Of course, that's super zoomed out. So let's see if we can find a happy medium. Let's see. Industrial production is something that everybody should pay attention to. It's how well things are going. And so what I like to look at is this thing called the capacity utilization rate, or the CAP rate. And this number has been going up. It's how well you produce. Like if you put $1 in, how well do you get that much money out, or your profit out? This number I can remember, and this goes to show you in the long term, for those of you that are paying attention to things like robotics and artificial intelligence, and the ability for like companies that make things to be able to make them with fewer humans, fewer people you have to pay for, fewer variable costs. I remember when I first started trading, this would never get above 70%. And this has been creeping up over the last 20 years. Now you can put in 10% less energy to get the same widget made. So you want to pay attention to this number, and it varies. And you can see that they were expecting it to be less than it is. But this is going to be an interesting situation as we go into the 2030s and the 2040s and the 2050s, because I have a feeling we're going to get to a point where we can make plenty of widgets and people don't have to be involved. So what are you going to do with all the people, right? The people need jobs, the people need entertainment, the people need something to do. So will there be other jobs? This is an interesting thing to look at in the long term. And as far as the short term goes, what this is telling us is that the Fed has room to continue making money expensive, because that's what the Fed does, right? That's what central banks do. In fact, I was looking at the European Central Bank, and they too have been raising interest rates on the euro. And they've also, get this, the same thing as with our Fed, they've been selling bonds back. So they did the same thing we are, and they're actually having they're having to go to more extremes. So even though it seems pretty crappy here in the States and up in Canada, we're in a way better situation than if you lived in Europe. And I know we've got some followers in Europe, but all to say, this cap utilization number and these industrial production numbers that were still stronger than expected tells the Fed that they can still tighten monetary policy. They can make money more expensive because it hasn't quite affected what's going on here. Another thing that we can look at is the retail sales. A lot of people were talking about retail sales this week. If you take a look at the retail sales and you factor out vehicles, cars can be quite volatile. So they take the retail sales number and they factor out vehicles. And then the other thing is purchases of gas, right? Gasoline is very volatile. So they take that out, and you can see that we're still growing. In fact, we're growing more than expected. Prices on retail sales, or the amount of retail sales is still growing. So the Fed can still raise interest rates. They're not having as strong an effect. And so they are feeling comfortable that they're not going too far yet. And I guess last but not least, we had the meeting minutes released on Wednesday, and I kind of went through them with a fine-tooth comb, and there was a lot of verbiage. There was a lot of back and forth on what happened in the July meeting that gives hints that the Fed isn't going to slow down on raising interest rates. In fact, I think the other thing that we look at a lot is them selling their bonds. And I think they're going to kick that up a notch, SIP. So here's that federal balance sheet. Let me zoom out on this one. And we like to look at the 3-month. So you can see here, they keep selling those bonds, right? The bonds are going less and less. And I think they're actually going to accelerate the selling. And remember, when they sell bonds, that slows the economy as well. So I know that they said that they're not going to be, they don't care what the stock market thinks. So I think they do a little bit, even though they're advertising that they don't. So we'll watch, but I bet you they'll do some aggressive tightening, especially with their bond selling. And then when the S&P hits 4,000, I bet you they'll ease off a little bit to let the market regain its steps. But I think they do things in lockstep.
Well, we've gotten this far in terms of a short-term market rally with 2 75-point basis hike moves to the upside. So the next meeting coming around, there's a likelihood it'll be 75, maybe 50, but they're continuing to raise because the inflation numbers are up. While we're on that topic, we'll run through some of the other names, but while we're on that topic, a good question came in this week from one of our members, and it seems to be a question that a lot of average folk might be asking themselves is, where are we getting this inflation from? How do we even get inflation?
Yeah.
And then we hear about it, and then we see all these effects, but the understanding of how it even gets to this point.
Yeah, and you know who asked that question? I knew you were going to bring this up. Our Manny, our 10-year-old follower, his dad is one of our program participants, and Manny likes to send in questions. And he said, why are we dealing with this? What's the cause? And Manny, first thing, the scoop is people can write their PhD dissertations on why this inflation bubble happened, right? So it's a very complicated subject, but in like a 30-second answer, which I don't know if I've ever given a 30-second answer, we had this pandemic can't come and the world economy stopped. People stopped working. People stopped making things. People stopped buying things. Then all of a sudden, limitations were removed one by one. People were at home and they were able to use the internet to start buying things, but things weren't being made. Then when things finally were being made, they all got shipped at once. And so then there became a supply backup. Like you just couldn't get things to people fast enough. There wasn't enough shippers. Things got backed up at like the place where the stuff comes from overseas into the ports and then gets distributed. Things couldn't get shipped enough. So then stores started to make pre-orders for stuff that they wanted to buy and make sure that they had the orders for. And then all of a sudden, people were allowed to go outside. So they stopped buying stuff. And so now all this stuff has been delivered to those retailers, and those retailers have a lot of stuff inventory and they can't get rid of it because now people like me and Sip are hanging out in person and we're going on trips and we're spending our money on experiences instead of stuff. So now the retailers are in trouble because they sunk all this money in inventory. And then add to that, this thing that's happening in the Ukraine where, there's fights and there's government sanctions against fuel. So the price of gasoline's been going up, but then there's all this meddling. In other words, the normal everyday things that happen naturally have been interrupted. And then there's these bubbles that form, and then they have to get pushed through the system, and things are just not steady, right? There's been just a bunch of disruptions, and that's caused a huge amount of inflation, and in order to make sure things didn't implode, be in trouble because of all of these world economies stopping, governments came in and printed money, made sure people had enough money to live. And now that all that money's out there, the governments are starting to bring it back out. In other words, there's just nothing being normal, and it's causing first inflation. We may see recession and deflation due to some of the meddling. We just want calm, right? We just want calm, and then things can start going back to normal. So that's kind of why inflation's happening. But the actual specifics, that could be like a college term paper. Question, buddy.
I also assume that an easy answer is oil prices, right? Mm-hmm. Because so many things get transported.
Food prices
if the price of what it costs to transport that good increases, and oil increased rather quickly.
Airplane fuel,
and so
travel,
and so there's a lot of reasons for inflation, and now we're at 9% and having to deal with it. So that's just the name of the game and where we're at with things. But Manny, great question. AJ, great insight. Let's go ahead and run through some more names, because that's one of the main reasons we have the show, is to find and to give people good trading opportunities. So let's go over a name that we've touched on in a couple of episodes, and one that's kind of in the news a lot, and that's the competitor to Tesla, ticker symbol NIO, the car manufacturer.
Okay, so I love NIO. And NIO, this is for those folks who like to be a little bit more active as an investor. So put your sights onto NIO. Now, you're going to need a way that's not as slow as the way I always talk about. So I talk about my signals coming from a fast MACD indicator. And the fast MACD indicator hasn't been fast enough to give me the signals on NIO. So what I've been using is actually NASDAQ level 4 data. And so those of you that are more active, you probably are familiar with NASDAQ level 4 data. It tells you exactly what's happening penny, second by second, penny by penny. And I'm watching as big investors come and go in NIO. And you can see just in the last 4 weeks, NIO has established this mini level of support right around here and resistance right around here. And I'm seeing, as big investors, every time it comes down to about $19, they start buying. And every time it comes up here to $21, they start selling. And they're just making, the big investors are just making money on this small kind of movement. Remember, money isn't made or destroyed in the markets. It simply changes hands. So when these big investors start buying, a lot of folks jump in on buying some NIO because they think something's happening. And guess what? The big investors will then start selling. And basically, they've just moved the money from the little people who follow them into their pockets. And they're doing this. They're kind of accumulating and distributing their stock holds in order to get this following. We can profit off of that, and I have been, right? When you identify some buying and selling, you can use weekly options. And this is one of the rare times that I've been getting involved with weekly options. And so I just go out every time I see a reversal happening. I just go out 3 weeks with my weekly options, and I will go ahead and sell the 3 week out, and I will buy an option as protection that's probably more like 3 months out. And then at the opposite reversal, I sell it back, and I just keep rolling it out at each reversal. And I've already, I think for the month, I am up something around 24% on NIO on just these reversals. So we featured NIO, I think, at the beginning of this move. And I think that if you're a more active investor and you've got some good signaling for tops and bottoms in your day trading, or even in your end of day, but more active than, say, weekly investor, you too could be working NIO, but you do have to have your wits in gear. But doing a transaction about every 4 or 5 days and using weekly options, NIO has been a nice one for us.
All right, NIO, we're definitely going to keep an eye on that. We'll keep it on the watch list. The next 3 names are tickers that I've never even heard of. So I'm curious if these are member questions, or if these are some new scanning names that came up in your searches.
These came up in my searches.
Let's go through the first one of Weber. Ticker symbol WEBR.
Weber, actually. Weber is the grills. The barbecue. People have, you look right here, people have been doing their barbecuing. Talking about stocks that are inexpensive. So Weber is around the $10 price range right now, and it goes down as low as about $7 or even as low as $6 recently. And so Weber, yeah, this is a good premium trade. It looks like it has formed a top up here. So if you wanted to short some Weber, or if you're not into doing shorting because you don't have a margin account, you can still do this trade by buying some puts. So let's take a look at the option chain. If I go out in time to say 17 March 2023, and I buy some in the money put options. So in the money put options mean the strike price is higher because puts work opposite of calls. So if I buy some of these $12.50 put options, that would be, it looks like the bid is 570, the ask is 670, so the mark is halfway in between, 620. If I buy some of these put options will profit on Weber going down in price, right? The put options go in the opposite, so they'll profit on Weber going down, and then the minute that Weber stops going down, I sell some put options. I'll sell some put options that are going to expire in the next week or two, or if I don't want to use weekly options, I'll sell the September monthly options, and I'll buy some protection. So I'll protect my put probably here at $9, and then it's just a matter of rolling those out. Each time I roll those out, I collect a little bit of income. I like this Weber grill trade.
I do too.
Weber just released earnings, so earnings can kind of throw some wrenches into the works. So because earnings are passed, we have another 3 months before the next earnings go. So that's 3 months of collecting income on Weber.
From what I see, I love the setup. So kudos to whoever brought that to the group's attention. Moving on to the next name, ticker symbol AFRM. Oh, what's this company all about?
I gotta get my fat fingers to work. Affirm Holdings. So they're kind of, if I remember correctly, they are a type of bank, I believe. I'm not sure, but here's another one. Now, this is a little bit more expensive. They're in the $30 to $35 range. But again, you see this pattern? No stock trader would ever want to trade this pattern because this pattern, you don't know if it's up or down. And stocks only make money if the price goes up, or if you're shorting the stock, it only makes money if the price goes down. What do you do with these ones that are kind of going sideways? That's where us option traders have a huge advantage because we can make money on sideways stocks by using options as decaying assets. We can sell our premium. So again, with Affirm, we can go ahead and buy a put option these days. It looks like earnings is coming. So I would let earnings go by. I would let the earnings go by and find out, where is Affirm after earnings. It doesn't look like, in the past, it looks like earnings maybe causes a tiny bit of gapping, but not too much. We'll see if that rings through. But once earnings has passed, we could either, it doesn't matter whether we're buying calls or puts. We buy that at one reversal, and then at the next reversal is when we sell. It's basically legging into a diagonal spread for you nerds out there that are into options. That's what we're doing. And I think Affirm Holdings looks like one of those symbols, especially if I go back. I look for these boring symbols that no stock trader would ever be interested in trading, that have been going sideways for months. And I learned how to make money on them with options. And so I wanted to highlight Affirm Holdings. Somebody highlighted it to me. I wanted to highlight it for the crew because I think you should be looking into Affirm Holdings.
Yeah, and upon further review, they are a banking company, and they're integrated into e-commerce. So if you've ever gone to a checkout and seen the little button there that's like pay now, pay now,
they're an e-commerce kind of gateway or a merchant account or something.
Yeah, and it's the whole they allow you to. It's kind of like layaway, like a modern layaway for e-commerce.
They're getting into the financing business. So that's kind of cool. That we like. So when we're doing option strategies, one of the things that helps anybody who's looking for predictable patterns is to find a company. Do a little bit of research on the fundamentals. Make sure it's a company that's not going to disappear or have any sort of shenanigans going on, that they actually have a real business that they're in. And so we like that. We know that e-commerce is not dying anytime soon. It's growing, not like shopping malls that are dying, right?
Yeah. And so our last ticker of the day is FCEL, and
Fuel Cell. It's interesting. They named their company Fuel Cell Energy, but they're into things like biogas, so creating gas from algae, creating gas from sugarcane, creating gas from corn. They're also into utilizing a lot of the natural gas that right now just gets burned off in flames. So I don't know how much of their effort is actually into fuel cells. I wonder if that's kind of a misnomer. But again, look, this is that boring pattern that most investors would be like, ugh, but us option traders are like, yeah. Same thing. It looks like they just had earnings. I think we can look up when the next earnings is coming, but it seems like if earnings over here was, the last one was, I don't know. There it is. Last one was June 9th. So July, August, September 9th is probably around when the next earnings release will be. I almost feel like you want to let that pass. I don't know if there's a trade to be had before then, but you could start paper trading this to see how it works for you. But whether it's a top or a bottom, and again, as option traders, I don't care whether I'm getting in at a top or a bottom. It just tells me whether I'm doing this transaction with calls or puts. All I care about is the fact that options profit if I sell them on time passing by. So whether I structure this using calls because I'm at a bottom or puts because I'm at a top, doesn't matter. I'm going to make money either way because I'm not making money on the directional move. I'm making money on time passing by. So I think Fuel Cell Energies is another one of those plays where we'll let earnings pass so we don't get surprised. Although, like I said, if you look at, if history has anything to say, earnings doesn't seem to phase the investors, but we don't want to be surprised. So let's let earnings pass. We'll watch this for the next 2-3 weeks. And then if it forms a bottom on us, you can either buy the stock, plus it's cheap. It's $5, which makes me want to know, is there options? So if I look, I'm going to turn off the weeklies because I tend to just trade monthlies. Oh, cool. So the option is trading every 50 cents. So what that means, SIP, is there's an option here, there's an option here, there's an option here. And remember, as much as people like to tell you that options, if you trade options, you're taking on risk, what you're really doing when you trade options is creating certainty. And you're saying, when you buy or sell options, you're saying, I want something to happen at this price. And it creates certainty. So for instance, if I say right here at $5.50, I'm going to sell premium, you're certain now that if this symbol trades above 550, you're going to get exercised out. That creates certainty for you. And that's what options do. So you have to like throw the naysayers out the window, because they're going to tell you, that, you know, options are risky. And I'll tell you every day, and all of the people in my program will tell you every day, that options actually create certainty around the prices you're doing transactions at.
Another thing just with this ticker is it's rare to have a name with such a low stock price, right? Like $3, $4. Like there's not that many names out there that are trading that low.
If you have a portfolio that's on the smaller side, I've had folks who have started with as little as $800 in a bank account. This is the type of stock you're looking for. One that has liquidity, meaning people are trading it. One that has the granularity in the strike prices, allowing you to make decisions at every 50-cent mark. And the ones that cost nothing, right? So if you lose a little bit, you're not risking your whole portfolio. Look at BBBY, Bed Bath & Beyond.
That was one of the questions that just came up from the chat, and I was going to bring it up. BBY, this is a meme stock, and it is all over the place, and people want to know what you think, AJ.
So this is there's nothing you can do unless you're unless you're already trading Bed Bath & Beyond. This is one of those symbols where the high frequency and the big money traders are going very quick. And so you want to, my theory on doing any sort of investing or trading is that you want to position yourself on the correct side of the equation. You want to make sure that you're in the position to make money and not give your money up to somebody else, because money is not made in the markets. I repeat this over and over, but money's not made in the markets. Money simply changes hands. And so what's happening in Bed Bath & Beyond is the big money investors, and I do believe that Bed Bath & Beyond has also, I'd have to look at the headlines, but is it one of those ones where a lot of people got together on Reddit and decided to raise the price and kind of outsmart? That's like the new hot thing to do, isn't it? So the new hot thing to do is to make sure that the big money investors know that the little guys are out there for them, right? So the little guys have been getting together and basically creating their own fund. And how they're doing is they're communicating on the internet, like through Reddit. They did this originally with GameStop and AMC Theaters. You might remember the headlines. They get together and they say, let's all pool our money and buy the same symbol at the same time. And by us all doing those transactions, we can have the same effect on a stock that these hedge fund traders do who manipulate the market. But if you're not part of that group and you're not in that inside knowledge, and instead you're following even a few minutes behind them, you're positioning yourself to be one of the folks that loses your investment. Okay, a lot of word salad that I just gave you. What I would suggest you do with Bed Bath & Beyond for now, if you're not in the trade, is come to the conclusion that you've already missed it, that it's going to come back down to about $5 or $6. And, you know, either these are the type of trades I don't pursue because they're just filled with a ton of risk. There's no predictability in it, you know, but I would not leverage any of my money on GameStop. But it does look like a classic breakout pattern. So in the future, what you can do on GameStop is you can have what's called a rolling straddle or strangle trade. Let's look at the option chain. So on GameStop, the option chain is every dollar. So what you can do, a straddle or strangle trade is one that allows you to profit on any sort of trade that's not going sideways. So for instance, if you set up a straddle at $6, if the trade goes up or down from $6, you make money. And so I would let Bed Bath & Beyond kind of stabilize, and then I would totally use a strategy like a straddle or strangle that you roll out every month to profit. And it's a little bit too complicated to get in the last minutes of this show, but straddles and strangles also can be set up to profit not only on the move of the stock, but on the anticipation of the move. So options profit if there's anticipation that the price will go up, but it doesn't really go up. So you can actually set up your straddle or strangle, and instead of going out 6 months, you go in like 1 or 2 months. And then if people start anticipating that Bed Bath & Beyond is going to go up or down, your option goes up or down, even if the stock never does. And so, yeah, you can fool around with that stuff. It's very risky. I would only use a small portion of your portfolio, and it would be only if you want to play a little bit. It's not something that I would set up in order to create ongoing income. The trades I like to do are the ones that are going to take your portfolio and consistently grow them in and out, in and out. Because think about it. If you start with a $5,000 portfolio and you use some of my strategies, you're probably going to be doubling your money about every 4 or 5, 6 months. So 5,000 grows to 10,000, 10 to 20. By the end of a year, you're at 20. At the end of 2 years, you're at 40 to 80. And once you grow your portfolio to about 100 grand, you can start taking a paycheck off of that. You could start taking a $50,000 a year paycheck off of that. And then you don't have to be worried about where your next job is, So I like growing my portfolio to that certain number, and I like my folks to think of what that number is. And if you don't want to be an active investor and you want to just, that number is going to be higher because passive investments don't make them much. So a lot of folks focus on actually a number like $1 million to 10 million, because at $10 million, you put your money into a mutual fund you never think about again, and you have a $500,000 a year paycheck. And then you never have to work again. I mean, I know a lot of people who can live on $500,000 a year.
Yeah. And that's one of the powers of premium selling and what you teach in the course, and why we invite everybody watching, everybody listening, to jump into AJ's free daily workshop. Go in there. It's updated every couple weeks, every 2 or 3 weeks. There's new examples coming in. So it's very, very current. And he's going to break it all down in, showing you, explaining how you can go about implementing these strategies. So highly
cost workshop. I mean, if people haven't checked it out, they should definitely check it out. It's a good, a good few minutes. You see exactly what we're doing. Of course, at the end of the workshop, if you decide that doing that kind of stuff in a group with us, there'll be an offer. But man, there's so much content in that workshop. You should check it out multiple times.
Yeah. Well, look, we survived our first live episode. I was worried there for a moment, being in person with AJ. He's gonna want to give me a big hug or something, but
I have yesterday. Sip, I also have to tell everybody, last week we told people about this apply for coaching thing that we did. I gotta say, you guys really took us by surprise. A lot of you came and filled out the form on our website and talked to our folks, and it's getting to the point where we'll have to take this website down because we only have like 5 coaches, and so their time is getting booked up. But I was surprised. I didn't expect as many people as we had in the last 7 days go on to this website, the Apply for Coaching site. So guys want a last minute. I think we have like 1 coach that has room left. If you want to talk to us, it's no obligation whatsoever. You don't have to buy our coaching, but at least you can talk to somebody. Our guys that are talking to you are not salespeople. What they are folks that have been through the same process. So if you want to get on the phone with us and see if coaching matches, but even if it doesn't match, learn, like, really be able to know what you're looking at as far as your current situation, and then look at where you want to go. Our folks will give you a free, session. Joseph is one of our best guys on the telephone, and he's got a cool Australian accent. So a lot of the folks, especially the ladies, like to talk to him. So yeah, if you want to know the fastest path from point A to point B, you should come over to this page. Did you put the website? Yeah. Click on that Apply for Coaching website that Sip just put into the chat area. And there's a little video that'll tell you exactly what you're getting into. And then below that is this calendar. And you put in your time zone. I'm on Pacific time. That's hard to believe. And then you can just pick a half-hour time, a 15-minute time to talk to Joseph. Pick one of his schedules. Like if you can speak tomorrow, Saturday, you can pick one of his times. And then as soon as you do that, I'm going to wind up making an appointment with Joseph. You can answer a few questions. It's optional, but it's good to kind of get your mind around some of the questions that he'll be talking to you about. Put your name, put your mobile phone, put your email address, click done, and then he'll give you a call. And last week we totally introduced this, and we had like 30 people call, and we wound up picking up quite a few folks who wanted to get some one-on-one coaching over the next year. And that was awesome. So we might have to take the website down, Sid, because there's too many people signing up.
Yeah, so if that's the case, those last few spots, head on over, click that link, schedule time to talk. If you're not sure, that's okay. That's why the call is there. It's to help you get the answers, because ultimately we want everyone that's a Trading Trader member to succeed financially and to utilize these wonderful strategies that are out here. So with that being said, AJ, this has been a great live episode. And, it's Fridays and you got the wife and the kids in town and you're going to be enjoying California over the weekend.
We're going down. I have a good friend, Sip. I don't know any of you out there who wear Vans brand, but one of my best friends is the head designer at Vans. So I'm going down to San Diego and we're going to go hang out in Solana Beach with him at his home. And we'll have a good, and then we're back up to LA next week. And then, I'm not going to be around next Friday. We're going to have to take the Friday off. So guys, we might not see you until 2 weeks from now. Apologize, but that's, I won't be around. I'll be out on a boat scuba diving, unless you want to do the show by yourself.
Yeah, probably not useful, but what we can do is try and get some clips of you scuba diving, and then on the show after that, we could show the people some of the action, because I know that's very interesting. We were talking about it yesterday, but also these last 2 weeks, maybe everyone should take a little bit of a break, get some sunshine, go hang out with the family, because once September comes around, it's going to be back to business. And, that's what we're looking forward to.
There's a trapeze rig in Santa Monica, I think over there. I think I'm going to go fly some trapeze this afternoon.
So
we'll see.
That's all we've got for you folks. Appreciate you guys tuning in. I know that I'm excited to be able to do a live show, and I hope you guys appreciate it. Appreciate the questions. If at any moment or time you have more that you want to ask, drop a DM, leave a comment on the videos. If you're enjoying the content at home and you want to tune in some more, hit that like, hit that follow, hit that subscribe button. And with that, AJ, any final words?
No, unless, by the way, we had existing home sales come out on Thursday, and so existing home sales have dropped. That means, the supply is getting less. The buyers are getting less. If you're into buying a home for the long term, you may be thinking this fall. So start looking now. Get your Zillow, get your Redfin accounts up, and this might be your opportunity to get a deal.
Lots of opportunity coming in the fall. And we'll keep an eye on some of the home builder names over the next couple of weeks.
Pulte Home, Ryland Home. Those are going to be some good tickers to be checking out for different types of premium selling.
All right, everyone. Appreciate you tuning in. We're going to go ahead and enjoy the sunshine. And we'll catch you guys in maybe 2 weeks.
2 weeks.
All right. Adios, folks.
See you.
Thank you for tuning into the AJ Brown Show. If you're interested in learning more about AJ and his investing techniques, head on over to tradingtrainer.com and create your free account today. And if you're not already a subscriber to the show, hit that subscribe button and we'll get you fresh content daily.